Hi, everyone. Thank you for joining me for just a few minutes today. The market's been a little bit rocky this week, and I've had a few questions come up. So I thought I would just spend a few minutes describing a few things that have come up in meetings and hopefully make a little bit of sense of what's been going on. This week has been another down week in the U.S. stock market. We're down about 17.5% for the year on the S&P 500. And that creates a little anxiety, of course, whenever you open your statements or look at your account balance. So I want to put a little bit of that in perspective today and hopefully give you just a few tools that you can use to process what's going on and hopefully give you a little bit of information that you can maybe talk with your friends about with regards to the market declines and how you're picturing those declines. So the first thing, of course, is standard disclosures as usual. And the next, I want to answer three questions for you today. So the first question, of course, is what's the key to resisting a panic in circumstances like this? You open the statement, and of course, the account balances are down. The natural inclination is to run for the exits. And so we discourage that, of course. And so we want to give you the tools for learning how to process that and understanding why we tell you what we do with regards to the market and how to stick with it. The second thing is, where's the upside in this particular market? What should we be watching for, and how can we stay optimistic in a time when there is so much negative news and also obviously negative performance in the portfolio? What can we hang our hats on to feel a little bit more confident with the things that are going on? And then finally, more specifically, what is happening right now in the portfolio, and what have we done to prepare for this time? So I'm going to take just a few minutes to talk with you about each of these specific elements. Before we get started, though, I want to do a little brain work. And what I mean by that is I want to describe for you how we typically, as human beings, process the world and how that translates into what happens in the way we view our portfolio performance. So one of the things that we have a tendency to do in our brains is to extrapolate to make sense of things that are going on right now. So what that simply means is that when we see an increase, for example, in the market, and especially if that increase occurs over an extended period of time, a couple of years, 3 years, for example, we just naturally tend to extrapolate that to a continuing increase. And you'll hear people say statements like, that's doing well, or we're really doing great in this. And that is essentially changing a verb tense from what should be past tense, that did well, to a continuous tense, this is doing well. And it is a slight change, but it basically implies that we're expecting a continuation of what's happened in the past. So it happens when the market goes up. It also happens when the market goes down. And it's especially acute when the market goes down, because when the market is going down, we're more fearful and we tend to revert back to the things that we trust the most, which is more extrapolation. So when the market has gone down, we use the verb tense, I am losing money. In fact, really, when you consider what's going on, maybe the market has taken the balance down. It doesn't mean it's going to continue to do that, but we tend in our brains to project on further and extrapolate to further losses. In fact, really, as professional managers, what we've seen in our careers is that when the market goes up for a while, we start to expect a decline. In fact, we're looking for the opposite. And we've been talking about this since last summer and even before that, before the pandemic, talking about how the markets were expensive and we would expect them to pull back. So, and the same thing applies when it's declining. So at some point, we start to view the market as oversold and valuations are frankly opportunistic, where there's an opportunity to invest in something at a much lower valuation. And so we would expect the market, rather than to continue to decline, to reverse and increase. And so over time, if you can get this psychology worked out for yourself, if you notice yourself extrapolating, so when the market's down, you just assume that it will go down further, or if the market's way up, you just assume that it will go up further, you should just check that a little bit and recognize that when the market goes up too much, it actually reverses and comes back. But the opposite is true when it goes down. So when we see declines like we've seen recently, we start to look for signs of increasing returns in the portfolio. So that's the first thing I'd like for you to recognize. The second thing is actually the key to being optimistic in an environment like this, and that is basically framing. And what I mean by framing is framing the market in the right time frame. So this key, you could say timing is everything. Well, it's not really timing that's everything, it's time that's everything. And this is a fascinating graph. What this is actually a Vanguard Life Strategy Fund, which is a basic 60% stock, 40% bond portfolio that Vanguard has managed since 1994. And this particular fund is basically passive. It's a lot of index funds. It's balanced 60-40, but it has kind of a market cap approach. And so we actually went back to 1994 to see how this fund had performed in rolling 5-year timeframes. So you may remember when you first started working with us, and many times since then, we talked about the market only being effective and reliable in longer time frames. And we say if you're in the market, you should have at least a 5-year time frame. So what we've done in this graph is we've actually mapped out all of the rolling 5-year time frames to see if we've been really right about that type of framing. There are 273 rolling 5-year time frames from 1994, September of 94, whenever this fund started. And so we've mapped them out and said September of 94 for 5 years, October of 94 for 5 years. Was that positive? November of 94 for 5 years. Was that positive? And what we found was that in that 60-40 allocation, that very basic allocation, that 270 of the 273 rolling 5-year time frames in that 20-year period, 28-year period were positive. And so when we say if you have a 5-year time frame in the market, you are just about guaranteed to have a positive return. We mean it because we see the data all the time. And then this is a perfect example of that illustrated. So in the last 28 years, this basic 60-40 allocation was positive 99% of the time. And the only time that it was negative was during the Great Recession, at the very end of the Great Recession, when the bottom line number was down about 2.5% over that 5-year period. Otherwise, a healthy return that exceeded 5% in most cases, even 10% in a lot of cases, but always positive, with the exception of that just 3 periods in the period of the Great Recession. So what we say is then, when you're focused on what's happening today, you've framed your performance incorrectly. We look at longer term timeframes, and that's how we can remain confident about the portfolio performance. So while it may not look so great today, I think you can feel confident in that time frame of that 5 years. You can relax and know that 99% of the time it's been positive over that almost 30-year period. The next thing that I'll describe for you is that question of upside. And I shared this with you in the last slide, but just to reiterate what's happening here. So there is a lot of negative sentiment right now. People are fearful. There is a news cycle right now that is relentlessly talking about inflation, relentlessly talking about recession. And that drives the consumer sentiment down, changes in sentiment around the market, changes in sentiment around the economy, et cetera. But there's an interesting phenomenon that occurs whenever the sentiment declines, and that is that the upside performance of the market improves dramatically as we hit low points in sentiment. So if you look at this particular graph, what it describes, it goes back 50 years, and it shows the low points of sentiment, and then the following 12-month portfolio performance on the S&P 500. And you can see back here in 75, the sentiment had dropped into the high 50s here. The next 12 months, the market was up 22%. In May of 1980, the sentiment dropped down here to almost 50. But the next 12 months, the market was up 19%. In October of 1990, the sentiment dropped into the low 60s. And the next 12 months, it was up 29%. And this is repeated over and over and over again. And as you can see, when we map it out to March of 22, the sentiment right now is at one of the lowest points in the last 50 years. You could argue there are only a couple of points on this graph that are lower than where we are right now. So the question then becomes, will the sentiment continue to decline before the market recovers? Well, what this graph tends to imply is that whenever the sentiment declines like this and it becomes severely negative, it's in advance of what could very well be a positive market. And if you just look at these numbers, without even including the 2020, which was a bit of an anomaly here, it was up 43%, but without even including that number, the market averaged 22% increase in the 12 months that followed a severe decline in sentiment. So as your friends are expressing fear and negativity and hopelessness, just know that historically that means the market has done well. And so in the last 50 years, we've seen example after example after example of low sentiment being a bit of a leading indicator, if you will, of a market that has the opportunity to recover. And that may be very well where we are right now. So the final thing that I'll share with you is what's been happening in the portfolio and what we expect to happen next. So I want to just share what we've done to give you some perspective on how we've anticipated. So the reason we have the football picture here on the left is because when people say the market is going crazy, it's down X%, what are you doing? We like to emphasize that trying to make changes in the portfolio while the market's down to avoid the volatility is a little bit like going out on the field and waiting for the hitting to start to put your pads on. We don't wait till the hitting starts to put our pads on. We've already made the changes, and sometimes years in advance of the volatility that we anticipated because of the metrics that we see. So as an example, US small cap stocks, this first illustration, have been very expensive for a number of years. We dialed back our exposure to US small cap stocks a few years back, and now it is down more than 27% more than US large cap stocks as of Friday. So that underweight of US small cap stocks has helped our portfolio performance because we just don't have the exposure to that asset class that was so expensive. The second one is how we've related to core fixed income. So core bonds are down 10-ish% right now. That's the Barclays Aggregate Bond Index. We diversified away from the BarCap Ag in December, around late 2020, because the interest rates had fallen so much. And we actually reallocated the portfolio, including both short-term high yield and an actively managed fund to avoid that volatility. So as a result, our portfolio is less volatile and outperforming the index right now by a really wide margin because of that relationship, and also positioned to outperform when the market actually turns because of the constituencies of the bond portfolio that we have right now. So we did that well in advance of these market declines because of the rising interest rates. We made those changes, some of them a couple of years back, and one at least at the end of 2020. The next thing is we've actually overweighted real estate for some time. And as you may know, real estate was the top performing asset class last year in the major asset class categories. And it is the only asset class, maybe minus commodities right now, but the only asset class that actually has a positive return over the last 12 months. And so our real estate allocation has enhanced the performance both last year and is protecting some of the downside this year because the performance of the real estate fund has been better. And then finally, we overweighted our international portfolio to value stocks. We've had a value tilt in our portfolio. Growth stocks in the US right now are underperforming nearly every other asset class. We knew growth stocks were expensive, and so we have kept away from growth stocks during this time frame, and they've declined significantly over the course of this the first part of this year. We had a tilt to value, which are a little less expensive, and value stocks are dramatically outperforming growth stocks right now. So our little portfolio tweaks along the way and many things that we did well in advance of the declines have enhanced the performance and helped us to outperform in parts of the portfolio all year long. Now, going forward, what are we doing? These are the things that we recommend for you in your portfolio, but also in general strategies for enhancing your financial plan. The first one is we're doing Roth conversions. We're actively doing Roth conversions right now for clients who have already established those Roth conversion thresholds as we did their tax analysis. If you'd like to convert part of your IRA to a Roth IRA, the best time to do that is during a decline because you bake in upside performance on your Roth. We did this back in 2020 and had some great results. We're also doing that now, and we're still expecting great results in the next few months. You bake in a payback on the taxes that you pay when you reinvest the Roth dollars in a declining market. The next thing is we're doing tax loss harvesting. So we will expect gains in the future. And so what we do is we pocket the losses that we can capture right now to offset those future gains, and that enhances the after-tax performance of the portfolio. So we're finding multiple opportunities now because we did some tax loss harvesting in March. The market recovered. We rebalanced the portfolio. The market declined. We were able to capture a few more losses. And so we've been capitalizing on this volatility in terms of losses, and a slowly declining market gives us those opportunities. The next thing that we're doing is we're rebalancing based on relative valuation. So with the valuations changing now, believe it or not, we're at valuations we haven't seen since 2018 and sometimes even before that. So we've backed up stock valuations for a number of years because the prices have fallen faster than earnings. And that creates great opportunities for purchases in the portfolio. And we're reevaluating what that means in terms of relative valuation in the portfolio, which is where we add value over time. Buying the things that are less expensive provides upside performance in the portfolio. Now, for you, if you're taking a monthly distribution, the portfolios are down enough now that you should turn the distribution off. We've mentioned having a home equity line of credit to draw from or using your emergency fund. It's time to do that. So if you feel comfortable with that strategy, I would recommend contacting the office and having someone turn the distribution off, let the market recover a little bit, and then we'll turn the distributions back on. But for right now, it's a good time to stop the distributions, only because if we go into the next month and we take another distribution when the market or the portfolio is down 10+%, it's just a larger percentage on the portfolio. And we can avoid that very easily by taking a little bit out of a home equity line or simply taking it from your emergency fund. And then the last and most important thing is I want you to remain patient. As you saw from that 5-year graph, time heals all wounds, and corrections like this don't typically last for very long. There are some hints that we may grind through this for a few months as the Fed sorts things out. And if that's the case, that's the case. But when you stretch it out over a longer time frame, and even just 5 years, you expect to be invested in 5 years. You're going to need growth in 5 years. If your time frame is shorter than 5 years, you shouldn't be in equities at all. But for most of us, we have a much longer time frame than that, and patience wins at all times. Last little hint: Warren Buffett has always said, when the market is greedy, I'm fearful, but when the market is fearful, I'm greedy. And you may have noticed that he just purchased $50 billion worth of a company. He thinks it's time to buy into the market, not run from the market. That should instill some confidence that right now is the time to capitalize on these great valuations. So I hope this has been helpful for you. I hope it's been informative. I hope you'll let me know if you have any questions. Of course, anytime along the way, I'm happy to help you. And if you need to schedule some time to talk, just let us know. We'll be happy to just discuss anything that you need to know about the portfolio, about the slides, and we'll be happy to discuss all of those factors with you as we go forward. And we'll be back in touch soon. Have a great day.